Introduction to market participants. Let's get started by looking at the big picture of who actually operates in the derivatives market. We can generally group everyone into three main categories: hedgers, traders, who are also frequently called speculators, and arbitrageurs. You can think of these three groups as the essential parts of a single ecosystem. While they have different goals, they all interact with each other to keep the market moving. Moving on to our first group, the hedgers. In the simplest terms, these are participants who are looking for a way to protect themselves. They face a lot of uncertainty because the prices of the assets they deal with are constantly changing. You can visualize a derivative for a hedger like an umbrella. It's a tool they use to shield themselves from the storm of unpredictable price shifts. Their primary goal is not to kill the risk, but rather to reduce the risk they already have. Now, let's look at who these hedgers actually are and what they are trying to manage. It isn't just individuals. Large organizations like banks, big corporations, and investment firms are the heavy hitters here. They use derivatives to lock in or manage all sorts of variables that could affect their business. This includes things like shifting interest rates, the price of stocks and bonds, or even the cost of raw materials like oil and grain. If a sudden price change could hurt their bottom line, they use a hedge to stay safe. Next up, we have the traders or speculators. Unlike the hedgers we just talked about, these participants aren't trying to avoid risk, they are actually looking to take it on. Their core activity is essentially trying to see into the future to guess where prices are going to go. Once they have a specific view or prediction, they take a position in a derivative contract, betting that the market will move in their favor so they can earn a profit. Moving on, let's look at why these traders often choose derivatives instead of just buying the actual stocks or physical goods directly. There are three big reasons for this: leverage, cost, and speed. First, let's talk about leverage. This is a powerful tool because it allows you to get exposure to a very large position while only using a small amount of your own money. You can think of it like a down payment on a house. You control the whole property, but you haven't paid the full price upfront. Second, there is a cost factor. For most traders, it is simply cheaper to use derivatives. This is because the fees and transaction costs involved are generally much lower than what you would pay if you are buying the actual underlying asset itself. Finally, we have speed. Because derivative markets are so active and deal with such high volumes, you can execute large trades almost instantly. It's much faster to move in and out of these positions than it would be in other markets, which is crucial when you are trying to act quickly on a price prediction. Alright, let's look at our third group, the arbitrageurs. These participants are looking for very specific deals that allow them to make a profit by spotting price differences in different places. Imagine if you saw a specific electronic gadget for sale in one town for 100 rupees, but you knew for a fact you could sell it in the next town over for 110 rupees. If you buy it in the cheap location and simultaneously sell it in the expensive one, you made a profit with almost no risk. That is exactly what arbitrageurs do with financial products across various markets. Now, let's see what happens to those opportunities over time. These windows of opportunity usually don't stay open for very long. Because arbitrageurs are constantly hunting for these gaps, they tend to rush into these trades as soon as they appear. What this means is that their very act of buying in the cheap market and selling in the expensive one eventually forces the prices to level out. In a way, they act like a self-correcting mechanism that closes price gaps and keeps the markets efficient. To wrap things up, it is important to remember that these categories aren't set in stone. These are functions rather than fixed identities. Depending on the situation, an individual might act as a hedger one day to protect an investment, but might act as a trader the next day to try and profit from a price move. The big takeaway is that for a market to really work, it needs all three of these participants playing their parts.